So here's a strategy on the triple Qs that I'm considering trading, option selling puts on the Qs every 28 days or 28 days expiry. So every Monday, Wednesday, Friday, sell a naked put at expected move on the triple Q. So let's see if that's a sustainable strategy. So for example, today, October 28th, if I sell 28 days, that's about November 25th. So if I go on option chain over here and I look at the expected move, first of all, let's go choose November 25th. Triple Qs have expiries every Monday, Wednesday, and Friday. So if I sell a put, if I start this strategy now, for example, and I sell a put on November 25th, which is 28 days to expiry, and if I go check for the expected move, so straddle value at 281, so 281 gives me about 10 plus 9, so about 19 points. So expected move would be 281 minus 19, which puts me at 281 minus 19 puts me at 262. So what does the 260 put look like? Naked 262 would pay about $3. So that would be the first trade of this strategy. How much buying power does that take? Well, depending on your broker. With Questrade, for example, 262 naked put on the triple Qs while the Qs is trading at 281 would take about 0.2 times 262 minus the difference of 281 and 262, so minus 281 plus 262 times 100 if it's one contract. So it would take about 33.40 USD buying power to put on this naked put trade, but you collect $300. Now, obviously, you only win on this trade if on November 25th, the triple Qs is above 262, but you can always close the trade at 50% if you see it profitable in a week at 50%. Then it makes no sense to hold it an extra 3 weeks just to collect the remaining 50%. And to win on this, that would mean that the triple Qs would have to drop from 281 to 262 in 28 days. So that's about a 7% drop, which of course is possible. I mean, we've seen it. Let's look at the chart here on the triple Qs summary. You can see in the last month it is slightly up in the last month. Let's look at the chart, the bigger chart here. So last month percentage, it's up 2%. If we go last 3 months, it's down 8%. So to continue with this strategy, if this option is a winner, then it's a winner. If not, if triple Qs drop to 262 and it gets, so your naked put gets tested, then you start selling calls to mitigate. Now there's obviously when you start selling calls and it's naked calls on top of that, there's a risk that the market comes back up and then you lose on the call. But for this strategy to work, you would have to start, I think you'd have to start selling calls to mitigate a put that's getting tested. So if the triple Qs drop below 262, then you start selling the call side. Now, of course, when that happens, the call is not going to be worth as much, but it'll give you extra premium to help widen your break even on the put side. And while you're doing that, you're selling the next put either a Wednesday or a Friday. So as the market's dropping, you're losing on the initial put, but it allows you to open a better trade on your next trade. So you're always following the market. You're sort of like laddering into the market. So if one trade is bad, the next one's better, and so on and so on. And then you just try to mitigate the first one. But the way I would play this strategy is I would not roll it. I would not try to save it at expiry. I would just close every trade regardless of how much it's worth. If it's a loser, well, at least I mitigated it with calls. So it's a smaller loser. And if it's a winner, it's a winner. But even if it is a loser, well, I've got other trades that are open that should be better trades. And so I paper traded this strategy for the last about 45 days, and it's been very profitable. But I know it's not always going to be the case, and because if you're starting this trade from the top, it's gonna hurt you at the beginning. It's gonna work if it's slowly dropping, but if it's dropping fast, your initial trades are going to make you lose a lot, even with naked calls. But then as it's gradually moving down, it still can be winners because your next puts are always going to be a little bit lower. So I thought I'd just give it a try here on this chart over here just to see what it potentially could do. Now you could see we just saw that the expected move was about 19 points. I've been paper trading it for the past 45 days, and expected move for 28 days was always around 20 points. Now it's gonna change. It's gonna vary based on VIX and the volatility. So the higher the volatility, the higher the expected move. But it's been for the last 45 days, it was around 20 points on 28 days. So let's go back to August 15. Let's say we would have started trading this strategy. So I need a Monday, Wednesday, and Friday. So August 12 is a Friday. So August 15 is a Monday. So you can see triple Q's open at around 3:30 on Monday. So if we had gone, let's say 20 points lower, and probably triple Q's at 3:30, the expected move was probably less than 20 points. But just for example purposes, we're gonna say 20 points. It was probably around maybe 17 points. So August 15, it opened at around 3:30. So 20 points lower would be the 310 put, expiring September 13. And let's say it's for $3. So let's go to September 13, see what it looks like. So September 13, triple Q's closes at 293. So you can see it's a big loss if we just held the put and did nothing. It actually opened at 301, 303, but then closed the day at 293. So it's about 10 and 7. So that put would be worth $17. So it'd be down $17. But along the way, while it was dropping, I don't think you would have had a chance to close this for a winner, because as you can see, since you opened the trade, it just kept dropping. So the value of the put, this $3 kept going up. Maybe over here it went up a little bit, but I don't think so. And then it just continued dropping. And then we're September 13. Actually, at some point it was even worse. September 6th, it was trading at, it also closed at 293. Where's September 13 then? September 13 closed at 293 as well. So in that case, I think that along the way you probably would have sold calls. So you probably would have sold starting off once it breaks your 310. So where's 310? You would look for the 310 here. 310 is around over here. So on August 26th, you would have started selling calls. That would give you about 4 and 13 days, so about 17 days remaining. So it would have been enough to collect some decent premiums on the calls. Probably maybe you would have sold at 320, and then if it continues to drop, your 320 call is profitable, so you bring it closer, you sell at 310, and so on. And you could go inverted if you want as well, all the way to maybe 300. So let's say you would have collected, I would say probably around like $6 from the calls. So that would have given you a total loss on this trade of about, I said 3 plus 6, 9, and then minus 17. So it would have been an $8 loss for this one. So next, but because the triple Qs, so August 12, it dropped right after, or August 15, sorry. So the next trade would be August 17. Triple Qs also opened at around 329. What is this? Why is it always opening in the same thing? So yeah, it opened at 329. So your strike would be the same thing. So on September 15, you would probably have the same strike, same scenario. So let's go here. September 13, 310 for $3. And then let's see what happened on September. Oh, I said 13, I meant 15. So let's see what happened on September 15, yeah. So September 15, triple Qs closes at 291 and instead of 293. So it's still going to be a loser. 291. So it's worth about $19. So $19 loss over here. But you would be selling calls on the way down for mitigation. So let's say this time you collected a little bit more. Let's say you collected $8 from the calls, because you kept selling calls as the market was dropping and rolling the calls down as the market is dropping. So let's say you would have lost that total loss as well of $8. And then next here, August. So after August 15, we've got August 17 and then August 19. So August 19, it opens at 326. So let's say I keep the same. It had a low of 322. It closed at 322. But let's say you place the trade in the morning. So 326 minus 20. So your next strike is going to be at 306. So I'm looking at the September 17. September 17, 306. And let's say, once again, as the market's falling, premiums are going to increase. So I don't know, let's say 3.3. It's not going to make a difference for this example purposes. So let's just keep it at $3. So September 17, where's the triple Q's at? Triple Q is, there is no September 17. So it's probably September 16 then. So September 16, triple Q's closes at 290. So that means this trade is losing about, it's going to be worth $16 as well at the at expiry. I don't think, you don't have a chance to close. There is no point where you had a chance to close it for profit, but you definitely did collect calls on the way down. Let's say this time you collected, I don't know, $10. So the reason I'm adding more on the call premiums is because as the market is dropping, the calls are going to be worth more as well. Volatility goes up. So the premiums that you're collecting from the calls are more. You're already losing on these ones, so you're being more proactive this time. So you're selling calls sooner and probably getting closer as well. So let's say you collected a total of $10. So 13 minus 6. So this time you'd lose about $3, let's say. So yeah, it sucks for this example here that I started off with. It's all losers, but that's why I picked this example, because I want to see how this would act in like the worst period, not the worst period, but in a period where the market is dropping. How would I end up with this strategy? So August 15, August 17, August 19. Next we've got Monday, August 22nd, I think. Yeah, so 19, 20, 21, 22. Yeah, August 22nd. So expiry, the next expiry 20 days later would be September 20th. Let's just check to see if there's a September 20th. Yeah, there is a September 20th. Actually, August is 31 days, so it's going to be September 19th. All right, so August 22nd, Q's open at 318, so minus 20, so that's 298. So let's say I pick a strike of 298 for September 19, a strike of 298. Let's say this time I'm collecting a bit more because, the market is dropping, so $3.5. Am I going to be collecting calls? Well, let's see September 19, what the Q's is trading at. Q's closes at 291. My strike is 298. So this put would be worth about $7. So minus $7. Did I sell calls on the way down? So August 22nd. I probably could have closed it here August 25th, but not for 50%, I think. It did come back up, but I don't think it's enough to close for 50%. So let's say I kept it. I wasn't able to close it. And then when did it start dropping below my strike of 298? So around September 1st, it dropped around 290. It dropped below my strike. So then you probably started selling calls around here. But then at some point, you got worried because the market came back up. So could you have closed it here? September 12, triple Q's is closed at 310. Your strike is 298. So your put is definitely closable here before even getting to expiry. So it's hard to say if the whole trade was closable because you would have started selling calls over here when it dropped below 298. It had a low of 292. So you would have started selling calls here, but then your call, depending on how far your call is, you probably could have closed the put. So you probably could have closed the put here, and then you're stuck with the call because I don't think the call will be closable at this point. But then as you're holding on to the call, accepting the loss, the market happens to drop back, and then your call is definitely going to be profitable at expiry. So on this type of trade, which has happened in my paper trading, let's say you would have collected an extra $3 from the calls that you were selling just to get for mitigation, but then it ends up being an extra profit for you because the put and the call end up profitable. But at this point here, if you close your put that you sold for 3.5, let's say you would have sold it for $1. So that means closing the put for $1 and then letting the call expire worthless. You would end up with this trade. So probably around $5.5 profit over here on this one. So next trade here would be, so we said August 22nd. So 2 days later would be August 24th. And just to make sure, 26th. So 24th would give me September 21st expiry. And let's just make sure September 21st, 19, 20, 21, 22, 23. Yeah. So August 22nd, so August 24th would give me September 21st expiry. August 24th, triple Qs is at opens at 313. So let's say minus 20. So we're at 293 for September 21st. So September 21st, we're at 293 on the triple Qs. Let's say we're collecting 3.8, let's say. And then September 21st, what happens here? Is it above 293? It is not above 293. It had a high on the day of 293. You could have closed it definitely then. But more importantly, Qs was at 310 on September 12th. Well, you had a naked put of 293 that you had opened August 23rd or 24th. So it was definitely closable at this point. Did you start selling calls? Probably not. Maybe here you probably would have started selling calls. Probably not, because it was just one day where it dropped below 293. But otherwise, you definitely could have closed the put around here. So let's say you would have closed it for, let's say you would have closed it for $1. So minus 1. So on this trade, you'd win about $2.8. Next year, we've got August 26th. Triple Q is open at 320. Okay, that's kind of high. But then it had a low of 307, closed at 307. So let's say you would have sold it at the open, which would have been not good, because it would have been better to sell at the low of the day of 307. But regardless, so let's say you would have opened the trade at the open. So you're selling triple Qs at 300 strike for September 23rd. September 23rd, triple Qs at 275. So that's not good. You're 25 points lower in that case. That's terrible. So September 23rd, we have the 300 strike. Why? Because on August 26th, triple Qs opened at 320. So 20 points lower is 300 strike. That's terrible. So let's say you collected, 3.4. Now you're gonna have to close that put for $25. So I don't know how you're gonna get out of this one. So you're here. Where am I? So over here, 300. Now the thing is, you have a strike of 300, and then it does fall below your strike. So you're gonna start selling calls here for sure. You would have already started selling calls. Maybe you would have sold a 320 call, and then the triple Qs come back up here to 311. So your call is still safe. Is your put closable at this point? You've got the 300 put, and some time has gone by. Yeah, I would say it is closable. So if you would have closed the put, you would have been safe. You wouldn't have had to buy it back for $25 if you had held to expiry of September 23rd. So this rally over here would have given you the opportunity to close this put, and you still would have had a call at around, like, let's say 320, which still would have been profitable. So I'm going to remove this because you should have closed your naked put. Let's say you would have closed it for, $1.50. And you actually sold a call as well, for, let's say, $3. So that gives you about $5.4. Next trade here, so the last one we said was August 26th. So next trade would be August 29th. Triple Q's open at 305. So we're going to take the 285 strike. So that's perfect. 285 strike for September 26th. September 26th. 285 strike for a bit more than that. So let's say 3.8. So now we said September 26th. We want the Qs to be above 285. It's at 275. But remember, we sold August, I believe 29th. I said we sold at 285. It did come down here. It never dropped below our strike of 285. So we didn't start selling calls. And then it went back up to 310. So for sure, this put would have been closed. So let's say it was closed for $1. You never had to sell calls, so no premiums on the calls. So that's a profit of 2.8. So next is August 31st. Triple Qs opens at 304. So you're at 284 for your next strike for September 28th. So September 28th, I said 284, and let's say about same thing, 3.8. September 24th, Well, there is no 24, so I don't know. Let's say so August 20. What did I say? I think I said August 29th, 30, August 31st, 26, 29, 30. So August 31st, 304. So let's see what day that is. August 31st is a Wednesday, so I'm looking for the next Wednesday in September. So that puts me at September 28th. So yeah, I'm correct. So where's September 28th? Why don't I see September 28th here? Okay, there it is. So September 28th is the Q above, is the triple Q above 284. No, it's not. It closes at 280. So even if you had held to expiry, it would have been a break-even trade. You would have closed the put for $4. But most likely at August 31st, when you had the 284 strike, come September 12th, when triple Q is at 310, this trade would have been closed, and you never would have sold calls. So let's say you sold it for you bought it back for $1, so that gives you once again a 2.8 profit. Next trade, August 31st would be what's after August 31st. So let's look at the date. August 31st is, I'm looking for September 2nd. If it was open, September 2nd, yes. So September 2nd, I'd be looking now, 28 days would be September 2nd, so it would be September 30th. All right, so next would be September 30th. So September 2nd, we've got 302, so about, let's say 282 now. 282, I'm going to say about $4. And then 282 on, what did I say? It was September 30th. Yeah, so September 30th. Wow, triple Q's closes at 267, so that's not good. But let's see what happened before. So September 2nd, what comes after? A little bit of, but never. So September 2nd never drops. September 6th, never drops below your 282 strike, so you didn't have to sell calls. Then it comes back up September 12th all the way to 310. So this was definitely closable. Let's say this time you close it for $1.50. So that gives you a 2.5 profit. So after September 2nd, we've got Monday, which is September 5th. So it's going to be October 3rd. So September 5th and October 3rd. So October 3rd would be the next one here. September 5th. Why is there not a September 5th? I guess the market was closed. So September 6th. Oh yeah, Labor Day. September 6th, we've got opens at 295. I'm going to remove 20 points. So 275. So I've got the 275 strike. I'm going to collect $4. And I said October 3rd. October 3rd, triple Q's is at 273. So pretty good. Closes at 273. So I would have, even if I just held to expiry, I would have lost $2. Would I have sold calls though in the meantime? But as you can see, September 6th is the low. I definitely would have closed it here at on September 12th. So this trade doesn't go to expiry. This trade is definitely closed, let's say, for $1. So that gives me $3 profit. Next here, what's after September 6th? It'll be September 7th, and it'll be October 5th. All right, so October 5th here. So September 7th, we're at, triple Q's is at, opens at 293. So we're going for the 273 strike, and we're going to collect $4. And once again, you most likely would have closed it when triple Q's is at 310. So I would say, once again, this one's a winner, equals $3. Let's make this window a little bit bigger. So October 5th, what's after? What's next? So October 5th, we've got October 7th with September 9th. Okay. So we said, where's my notepad? So October 7th with September 9th. So September 9th is over here. Triple Q's opens at 302. So we're going to pick around the 282 strike. We're going to say 3.7 collected. October 7th, where is the triple Q's? It's at 270. Closes at 270. My strike is 282. So it's 12 points in the money. So it's a loser. But in the meantime, if I open it September 9th at 282 while the market was at 302, even the same day it went to 307, so probably could have closed it the same day, but probably not. Next day it goes to 310. Not sure it would have made 50% in 2 days. It's possible. So there's two scenarios here. It could have been closed for 50% in 2 days. Maybe you wanted more than 50%, so you didn't close it. but then you start regretting it because the next day it just drops even more. So let's say you didn't close it, but then you start selling calls when it drops below 282, which actually takes time before that happens. Yeah, it happens around here. It happens around September 22nd. So you sell a call, I don't know, let's say at 300, and you still have time, and then you start selling it at 290, and so your call is still safe. Your put is breached, but you start bringing your call closer, so you bring it to 280. So you're collecting premiums from the calls without moving your put, and let's say you bring your call all the way down to 280, and you would have collected, I don't know, let's say $6 all the way down. You would have collected $6 in premiums from the call, but then you have to close your put, which was, I said, October 7th. Where is October 7th? Actually, when it comes back here, no, not really. I don't think it's closable at this point. October 7th, it's at 270, close at 270. So then you have to close your put for $12. So then, in this case, it would be a small loser of about maybe $3. So it all depends on how much you collect from selling the calls. So it'll be different from person to person how soon you react. But just to give you an idea of how this strategy would work, that's why I'm just using these numbers here. It's definitely not accurate. I'm just giving you like the thought process or the approach that I would take if I sell this strategy. I'm paper trading it right now, but I am paper trading it in a period where it worked very well. But I didn't try it in a period like this where the market is just dropping hard. So after October 7th, we're going to have October 10th. So that will be September 12th. So September 12th to October 10th. So October 10 expiry, we would have opened it on September 12th. So we actually would have opened it on the peak here, the highest peak, like the small bear market rally. So it opened at 308, so our strike would be around 288. Is that 20? Yeah, that would be 20, right? Yeah. All right, so 288. Let's put our strike here of 288. We collected, I don't know, 3.4. So that's definitely never had a chance to be closed as you're getting to expiry to October 10. Never had a chance to be closed. Over here it's at 280. Yeah, no chance. October 10th, it closed at 266. So it's definitely a loser. We're going to remove it right now. So 266 minus 282 is 16. 282 minus 266, yeah, 16. But you definitely would have sold calls on the way down. You would have started selling calls when it breaks your 282 strike, which happened around here, September 22nd. So you have about 20 days to go. So the calls, you would have collected a lot from the calls. And then you keep bringing your call lower. You keep bringing your call strike lower as the stock drops. Then all of a sudden stock comes back up. Then you're worried about your call, but you don't do anything. Or maybe the whole trade, you have a strangle now, and maybe the whole strangle is maybe closable altogether. Who knows? Hard to tell, but that is a possibility. But let's say it starts. So the call, you start selling calls around here when the triple Q is at 275. Let's say you start off with the 290. You don't have to sell. You don't have to turn it into a straddle right away. You start with a strangle. So you sell a call, let's say at 290, and then bring it, as the market drops, you bring it down to 285, and then 280, let's say, and then all of a sudden, market jumps back up to 280. Market jumps back to 282, but you don't do anything. And then you have the 280 call, let's say, and you've got the 280. Well, you're not going to have the 282 call. You're not going to have the straddle right away. You're not going to be inversed. So you probably bring it to like 285 call, or maybe 280. So let's say you collected, I don't know, let's say you collected $5. I think that's reasonable. Yeah, so this one's pretty bad. Unless you go more inverted on the call, then you collect a little bit more. Let's say you collect $7 by going a little bit more inverted on the call, and it all depends on how soon you start selling calls as well. So this is what's gonna make this. This is what's gonna change your P&L on this strategy, is how much you'll be selling on the calls, because it is risky because you're afraid the market comes back up and then your call is in trouble. But yeah, so it depends how much you collect on the calls. But even if that happens, you sell a call because you're mitigating and the market comes back, your call's in trouble. But if your call's in trouble, that means all your puts are winners. So it's going to compensate a little bit. So now that means 7 plus 3, 10. So about, let's say, a $6 loss on this one. So we start losing again. So now go back to October 10th. So next expires October 12th with a September 14. Yeah, September 14. So October 12 and September 14. So let's go to September 14 on the chart. We are at 294 minus 20 is 275, let's say about. So 275. Where are we on October 12? October 12, we are at 262. So we definitely started selling calls. Not sure if by October 4th we probably could have closed the put. If we didn't sell calls by October 4th, maybe we could have. Actually, no. September 30th, it's at 267. So we definitely started selling calls at September 30th. So we have the 275 put. So we start off by selling the 285 call. It doesn't get breached here, and then what happens here? It drops back down below 275. You bring your call closer to 280, so you're left with 275, 280 strangle, and then October 12 it's at 262. So you're down $8 on the put. Oh, so let's say you collect $4 on the 275 put. You close the put for $8, but let's say you collected, I don't know, $3 or even $4 on the call. So yeah, this one would be break even. So next here would be expiry of October 14, I believe. October 12, yeah, October 14 and September 16. So October 14, I think this is when I started, I think my first paper trading, my first expiry was October 14. So starting from here, they were pretty much all winners. So October 14. So September 16, market triple Qs is at opens at 287 minus 20. We're at 267. Yeah, I think I remember. I think I had in my paper trade, I had 266 as a strike, and actually it got breached. It went all the way down to 260, and I sold a call at 275. I think I collected so much premium altogether from the put and the call. I was able to, but then luckily, one day, I think 2 days before my expiry, the stock was at 260, closed at 260, and the next day it rallied to 270. I was able to close the entire trade for $2, and I think I collected $6 from in total from the put and the call. So that was a $4 win. So let's just put $4 right away because I remember this trade. I was doing it live. So let's just look on the chart what it would look like. So I would have had the 267 put starting September 16. And obviously it just keeps going down. I have no choice but to start selling calls, and I do. Comes back up a little bit, but then goes back down. I bring my call closer, and on October 14 it comes back. So luckily on October 14 it goes back up, so I'm actually able to close the trade. So if we look at these numbers here, I think overall it's a loss, and if it's not a loss overall, it's probably close to break even. And is it worth all this time? So 0 minus 3 minus, I think I'm missing something here. Let's make the window bigger. Yeah, I started off with 8. So 0 minus 8 minus 8 minus 3 plus 5.5 plus 2.8 plus 5.4 plus 2.8 plus 2.8 plus 2.5 plus 3 plus 3 minus 6 and then plus. So for the whole month, I'd be up $380 with this strategy in this example with one of the, well, not the worst, but a pretty good drop, a pretty decent drop. So moving forward, I can confirm that expires all the way to November 21st were all winners. The lowest strike I ever had was November 11th. My strike was 240, and which I was able to close rather quickly. So this strategy was very profitable because, as you can see, it's pretty flat around here. But when it's a steep line down, or when it's dropping hard, then you're gonna have to take losers, and it all depends on how much you collect from the calls that you're using to mitigate. And by the way, when you sell calls, if it's a strangle, it's using the same buying power, but when it becomes an inverted strangle, it's going to use more buying power. So it becomes an issue with buying power as well. Your existing put is going to take up more buying power because it's less out of the money because the market is dropping and getting closer to your strike. So it's going to take more buying power. So that's the risk with this trade. You're more exposed to the craziness of the market. And this is just this part here. But if I zoom out on the chart, you've got another part right here. So this section would have been a loser or maybe a small winner for the whole month. You've got this section as well, which is going to hurt you for sure. And then you've got this section as well here. That's going to hurt you. So for this whole period, I mean, there's a 30-day period. There's several 30-day periods where you're going to be profitable. But here, let's do 1 month chart and let's scroll all the way. When did the market start dropping? Oh man. So let's put January. Okay. So let's look at a 1 month period and then go all the way to January. So this is a 1 month period starting January. You can see triple Q's close at 400 and then 30 days later it's around 368 and you've got a point where it's at 340. So this one would have been a big loser. So you definitely would have had to sell calls, and triple Q's at 400. So VIX is much lower. So it's probably a 15. My strike is probably going to be 15 point lower. So I don't know, like 385. I would have collected maybe less than $3. So 385, and as you can see, it closed 28 days later. About, well, this is February. It should be end of January. Yeah. So end of January, about 28 days. So it closed at around 350. It even had a low of 337. So close around 350. So that's about 35 points in the money. So that's $3,500 if I just had the naked put without selling calls. But that's why I think it's important to sell calls in this strategy. But once again, it all depends how much. You definitely would have been inverted. Your strike of 385 was breached very early. So you start selling calls. Your 385 put is completely breached. You bring your call closer and closer. You start collecting more credit. But it really depends. Probably you would have collected, I think, max, maybe best case scenario, $15 from the call in premium. And that's best case scenario. So 15 plus your initial credit from the put is what, $3? So let's say $18. Even if you say $20, I mean, January 28th, you're buying back the whole trade for $35. So that's a $1,500 loss for that put. And it's going to be followed by another one too, pretty close to it as well. If it's not 1,500, it's going to be like probably 1,300. And another one. Well, actually, maybe this one. See, this one, if we have January 7th, see, definitely volatility has already increased. Q's at 385. So let's say we go to 370, maybe even 368. Let's say 370. And it's actually, we're not that far off. We're at 368. So as you can see, they don't all follow, but it really depends on how hard it falls. Because it depends, because as the market's falling, your next strike is going to be better. It's going to be lower because the market already fell and you're collecting a little bit more premium and expected move is higher. So your strike is further. And it's also on a stock that has already dropped. So yeah, so this is a strategy that I'm still paper trading it, but I'm considering it. I like the fact that it sort of has a built-in hedge. So this is similar to the SPY strategy that I was talking about. SPY put credit spread every Monday, Wednesday, Friday. But this one's going to be naked. The advantage of going naked is you collect more premium. So that means your break even is further. So if I've got a 400 strike and I picked a 385 strike, I collect $3. My break even is 382. But with the put credit spread, my break even is going to be 384. It's going to make a difference when my premiums are higher, and I can close the trade faster as well. If I collect $3 and the market's flat a bit, my naked option is going to decay faster than the spread. Also, I can when I sell naked calls as well, it's going to make a bigger difference as well. Now, something like March 2020, like COVID, triple Q was at 236 at the high, and it dropped all the way down to 170, 236. So it's actually not that bad, but for sure expected move at this point was not 20 points. So I don't know, let's say 10 points, 12 points. Let's say 10 points, or even less actually. So yeah, it would have hurt. It would have hurt a lot at the beginning, but you would have needed to sell calls to mitigate. So let's say February 19, I go to March 17, I'm at 236. So let's say I've got the 230 strike on the triple Qs. Never had a chance to close for a profit. And then what did I say? March 17, which is probably the worst day or the lowest day. March 17, Qs closed at 182. So I'm about 50 points in the money. So that's a $5,000 loss. But that's if I just have the naked put and I don't mitigate with calls. But to mitigate with calls, if my put is at 230, I'm definitely inverted, which means my buying power goes up. So it's not as easy as it looks. There's definitely a lot of risk with this trade as well. And I don't like the idea of saving the trade and rolling it anymore, because you never know when the market is not necessarily going to go back up all the time. And as you can see here, it just keeps going lower and lower. And imagine you had a naked put on triple Qs here at like 380. So imagine you're still rolling a put at 380. It's impossible. It's impossible to save it unless you're completely inverted. It's going to take so much buying power, so much stress. So yeah, I don't believe in rolling anymore. So I would just close the trade and open a new trade, but mitigate the existing trade with calls. I used to hate mitigating with calls because the calls would always the market would reverse and I would lose on the calls always. So let me know what you think about this strategy. So selling a naked put on the triple Qs every Monday, Wednesday, Friday with 28 days expiration, and then mitigating the tested puts with calls as much as you need. So bringing down the calls, not selling extra calls, always one put for one call, and just keep bringing the. And obviously this is a strategy you could do with Questrade or with Interactive Brokers, and I've got 2 affiliate links for each, so use them if you want. Thanks for watching.